Hi, it's Josh with CupAd again, and today we're going to be talking about the monthly balance sheet. Now, what you see before you is a very primitive monthly balance sheet. Now, some notable features about this balance sheet are like the accounts receivable. So, what is the accounts receivable? Accounts receivable, denoted by A-R, is basically when you get paid for whatever you're selling. So, for you as a coffee shop, your accounts receivable is when you get paid to sell that cup of coffee in the morning. So when someone comes in to buy your cup of coffee, they're paying for it right then and there. You don't have to wait for them to pay you later. So your accounts receivable is essentially zero. So that's what this is showing right here. Other businesses might have an accounts receivable of 15 or 30 days, and you have to actually change some things with this if you do have an accounts receivable like that. Another notable thing to consider is your accounts payable. Now, if you look at this example, your accounts payable is pulling from salaries payable B5. So we go to the salaries payable B5, and you see that all it is the summation of your salaries. So we come back to the monthly balance sheet, and this is basically saying that you're paying all of your salary up front for month one. Now, this isn't true because you're not going to pay your employees all the money up front before they actually work. You're going to probably pay your employees every 2 weeks. So we have to make some changes to this. So since there's about 4 weeks in a month, and this is a monthly balance sheet, we're going to have to divide this by 2. So you come in, you put parentheses in the formula, you add your division deal, and you put a 2 in there and you press enter. Now you're going to have to change this next month as well. Now this, what you're going to do for this month is you're basically going to divide it by 2, but you also are going to have to add in the 2 weeks for month 1 that you haven't accounted for yet. So all you have to do that is put this in parentheses and put a little plus sign here and press on this cell. So now you've accounted for month 1 salary payable. So you do that all the way across the entire spectrum, assuming that you have an accounts receivable or accounts payable of 15 days. Now, another notable thing to consider is your paid in capital. So what is paid in capital? Paid in capital is how much money you have to raise to actually make this thing work. How much money you're going to have to raise to open that cafe or coffee shop. So for this example, we're assuming that amount of money is $80,000. And this is important because when you change this number, it's going to change your monthly cash flow sheet. So let me do an example real quick. So it's at $80,000 here. You go to your monthly cash flow sheet. You notice that you have a cash balance of $32,000 in month 1, year 1. We come back here. If we make this 0, it changes all of these. You come back to your monthly cash flow, and all of a sudden you're $47,000 in the hole. So this is important because you can figure out exactly how much cash you need to generate to launch your business. Is $50,000 enough? I don't know. Let's see. No, it's not enough because now you have negative cash flows here. So that concludes our tutorial for this, except for one other thing. You'll know that you've done something wrong with your balance sheet if you start adding other things like depreciation and things. If your total liability and equity does not match your total assets. If these numbers right here and here aren't matching, then you've done some programming wrong. So if you want to add you want to get more complex with this and add in depreciation and things like that, then you're going to have to be mindful and always watch your total assets and your total liabilities and make sure that they are equal.